is going to be on Ifvgs, also known as inverse fair value gaps. I'm going to show you how I use them in the market, what they're useful for, and yeah, I think that's all I'll cover on this. But essentially, if you know what a fair value gap is, it's just a gap in the market where orders need to be filled. So it's kind of like a draw on price, I guess you could say. So for example, this is going to be a bullish fair value gap that we see right here. This is a 15-minute. Again, as I always say, the higher the time frame, the higher power it holds, okay? So since this is a 15-minute fair value gap, it's a very strong fair value gap. So we're not anticipating, an inverse like this. This is an inverse, okay? An inverse is essentially when we close below the fair value gap. I don't really look on 15-minute, but I'll show you how you can determine your bias even further with these higher time frame fair value gaps. But essentially, you have to wait for the close of the candle for it to be a confirmed inverse fair value gap. You cannot just enter while the candle's still moving, because it can come back and be invalid and the price can go in the other direction of your trade, okay? So right here, we have this bullish fair value gap that we created, and what you're going to see in the market is us moving down, and we tap into it, and you may see a little bit of a rejection, but it looks like we just went straight through it. But essentially, when we inverse a fair value gap, we anticipate lots of delivery to whatever side we inverse. Let's say we inverse a bullish fair value gap, we anticipate bearish moves in the market. If we invalidate a bearish fair value gap, then we're anticipating bullish moves in the market. Right here, here's another fair value gap. Earlier, we rejected off of it right here, and then later on, we inverse the fair value gap, okay? Now, I don't really use them on the 15-minute time frame, or the 1 hour and stuff, but it's always good to look for them in the market, because see right here we're approaching all-time highs again, which sucks, but we're gonna have little rejections off these. But essentially, how you would use them on higher time frames is, for example, this is actually a perfect example. So we have this massive leg down, and then we're slowly starting to move up. But then all of a sudden, we are tapping into this bearish fair value gap. And when we don't inverse it, we're just going to show rejections. So we show a massive rejection off this bearish fair value gap, and we move down close to 200 points, okay? And you can also pair this. It's the same exact concept with ES. If NQ didn't tap into this yet, but we tap into it in ES, we would anticipate a move downwards still. Okay, I'm getting a little bit off topic, but here's how I use IFVGs in the market, inverse fair value gaps. So I look for, obviously, my SMT or my draw in the day, and then let's say I find my draw. So let's say, I'll go back in the market a little bit. Okay. Down here would be a perfect example, okay? So let's say we create an SMT right here at these highs, okay? Let me just mark that out. Let's say, this is all pretend. This is not actually what we did, but let's say we create an SMT at the highs. We have some sort of order block rejection, just something else to confirm our bias. Now, you could even catch this at the very, very top. This could actually be a very, very vulnerable trade for you. It just depends on how you play it. So, for example, we have a fair value gap right here, okay? We have this fair value gap. We're going to mark it out for ourselves and know that it's going to be here. And we're either going to show rejection or we're going to inverse it. Now, this is a crazy big move. This is not what's going to happen all the time. But notice how the second we inverse this fair value gap, we're just showing price delivering to the downside constantly. And we have no big up moving candle until, how many minutes later is that? Until almost 20 minutes later. So after we inverse a fair value gap, we have big moves down, okay? Now, notice how we also have a fair value gap down here, okay? We have a fair value gap down here. Oh my God, I did not mean to do that. We have a fair value gap down here, And then we have another one, a little bit of a smaller one down here, okay? So we have all these fair value gaps. Now, you can choose when you want to enter, but I like to enter off the first presented fair value gap, inverse fair value gap, I mean. So what am I doing? Well, I'm going to watch and see if this fair value gap gets inversed, which means we have a close below the fair value gap. So what is this? This is a bullish fair value gap, okay? Wanna know why? Because these are bullish candles. So we have a bullish fair value gap. We come down, and in real market, you're just seeing it, dance around here and might come back up, or it might just dump. But we wait for a close, okay? You may not have the best entries, and if you don't have a good entry, do not take the trade, okay? Look, we have plenty of fair value gaps down here that we could inverse and enter off of, all right? So if you were to enter this trade, we are waiting for the close, which means the close is going to be all the way down here. And what am I going to be targeting from the stop loss? My stop loss is probably going to be at this SMT. And since it's such a lower risk, I like to put on 2 cons, okay? And then my draws are going to probably be down here, this prominent low for 62 points, or just any of this liquidity, this Lang liquidity, anywhere within here, okay? And this can deliver you a nice R-to-R, 1 to 4, obviously, and a good amount of points. Now, market will not always go this far down, so you have to watch out for that, okay? I normally go for like a 1 to 2, if not that, like a 1 to 1. So I would have probably targeted this low for, a 1 to 2, or even like this low for 1 to 2 again, or this for a 1 to 2. And then my break-even point would be somewhere in the middle, okay? Now, let's say if you didn't like this first trade, right? If you didn't like this first trade because we closed so low, you're just looking for another fair value gap that we might inverse, okay? Actually, I do want to point this out. You can have fake inverse fair value gaps. Look at this one right here. We have a fair value gap, right? Oh, look, we inversed it. We're going to go down. No, you need to find a big confluence, something that's, has very strong, I guess you could say, power over the market, okay? So I'm not entering until we see something that's confirming us to change, the state of delivery, change the bullish momentum. Because obviously, as you see, we're in a bullish momentum, and then boom, let's say we had an SMT, we changed to bearish, okay? So not all inverse fair value gaps work. But as I was saying, let's say you didn't like this first one because your entry was going to be down here. Now you wait for this one, and since we have a close that's so much higher, or we have a close that's not as low down, this can also give you a better entry. So you can target less if you want. So since we inverse this, and we did create since we inverse this, but we created a fair value gap still, I'm going to just put my stops at that top of that fair value gap. And then I'm going to be targeting the same area. Just because, you change your entry doesn't mean you shouldn't target the same area. So, I'm going to be targeting this prominent low, anywhere within here, this low, pretty much any of these lows would have been good target spots because this is the accumulation zone. As you can see, accumulation, and then we have a little bit of accumulation, distribution, and then accumulation, and then distribution. This is the manipulation move, and then this is the distribution move, okay? So accumulation moves, manipulation move, distribution, all right? So we're just looking to target, the manipulation kind of time, because that's when price wanted to come back down to, all right? So that's inverse fair value gaps for you guys. I use them on the 1 minute time frame. You can use them on any time frame, to be honest. You always have to be looking out for them, because if we do have a fair value gap, let's say you're looking at the 5 minute time frame, right? And we have a fair value gap, but you're taking a 1 minute inverse fair value gap entry, it might not play out because you have a higher time frame fair value gap in your way, okay? But for example, let's see, on the 5 minute, we have this fair value gap, And this is actually a perfect example of some people get really, really confused, okay? Look, we blow all the way through this, but just because we have a wick through it does not mean we inversed it. We have to close through this fair value gap, okay? It needs to be closed like this. Look, we closed, bam, all the way down, okay? You need to have a close. Do not just think because we wick through it, it's valid, all right? But like things like this, you notice how much this wick goes down, right? So you might see this 5 minute, and there might be a 1 minute inverse fair value gap within here, and you're like, all right, well, I'm going to take this 1 minute inverse fair value gap, and then the trade starts playing out. You know, it gets down here. You're like, oh, it's going to hit my TP. Let's say your TP is right here. No, since we had this 5 minute that we never closed below, you're going to get stopped out. It's going to come back up. So you need to look out for all these different fair value gaps. You need to see if we're inversing them or if we're respecting them. Okay, so look on the 1 hour for prominent fair value gaps that might trade in the opposite direction of the trade that you're trying to take, because let's say you have a bullish fair value gap and you're trading bearish, then you might get screwed here. Okay, same on the 15 minute. I'm doing the same as I would on the hourly, making sure I have no fair value gaps or inverse fair value gaps going against my buys. And then on the 5 minute, I will use sometimes the 5 and 3 minute. I don't have it starred. I don't know why, but on the 5 and 3 minute, I am looking for, you know, just normal inverse fair value gaps or even just fair value gaps that might stop me out. Same on the 3 minute. And for the 1 minute, this is kind of my entry inverse fair value gap. If I see a inverse fair value gap on the 1 minute, that's kind of where I'm going to enter at and feel the best off of and get the best entries. Okay, so that's inverse fair value gaps. It's a pretty simple concept. If you know what fair value gaps are, it's literally, I'll just go over it one more time for you guys. Boom, fair value gap. What kind of fair value gap? Bullish. Bullish fair value gap, okay? Now, we just go straight up, we're ignoring it, and then boom. Later on in the market, what do? We come down, we tap into it, and just because we're coming down fast does not mean we're going to inverse it. But off this candle, we inverse it. Now, it doesn't mean we're going to dump fully, it doesn't mean we're going to dump right away, but if you entered off of this candle, and as long as you had your stop at even just the top of this fair value gap, you could have targeted any sort of lows within this area. I probably would have targeted, this low right here. Okay. And that's going to deliver you a 1 to 4 and 63 points. Okay. So an inverse fair value gap is a fair value gap that gets closed below. It works on any time frame, but if you want to use it for, entries, use it on the 1 minute.